Welcome to the deep dive. Today, we're going to try and cut through some of the complexity around a really key bit of finance.
Yeah, something that pops up a lot.
Exactly. How companies account for investments where they have, a significant say, but not outright control.
Those associate investments.
Right. You've probably seen that investment in associates line on financial statements. Well, we're going to decode what that actually means under the two big global accounting standards, IFRS and US GAAP.
And we're drawing directly from source documents that compare them, so this is really about the core information.
Yep, straight from the text. Our mission today, to give you a clear, sort of actionable understanding of how these significant influence relationships end up looking in the numbers.
Exactly. Think of it as the accounting for those middle ground relationships.
Not just owning a few shares, not a full takeover.
Precisely. It's when one company can genuinely influence another's big decisions, financial, operating policies, that kind of thing. And both IFRS and US GAAP called this significant influence, which, as our sources point out, means having the power to participate, but critically, not control or joint control.
And there's that benchmark number often mentioned, right? The 20%.
Yes, the 20% voting rights figure. It's generally presumed that if you hold 20% or more, you likely have significant influence.
Okay, so it's like a starting point, a flag maybe. If a company owns, say, 25%, you'd usually assume significant influence.
Usually, yes. It's a useful indicator. But, and this is important, both sets of rules are clear that it's just a presumption.
Ah, so it can be overridden.
Definitely. You have to look at the bigger picture. Our source material emphasizes this.
What else might signal influence, even below 20%, or maybe negate it above 20%?
Well, think about practical power. Even with, say, 15%, if you have a seat on the board or you're involved in their major strategy talks or there are significant deals happening between the two companies.
Right, real involvement.
Exactly. That points towards influence. On the flip side, you could own 25%, but if another shareholder has 60% and calls all the shots, your 25% might not actually give you significant influence in practice.
Okay, interesting. So it's about the substance, the actual ability to weigh in, not just the percentage on paper.
Precisely.
So once we've established that, yes, there is significant influence, what's the main accounting method both IFRS and US GAAP generally use?
The main approach, the standard way under both systems, is what's called the equity method.
The equity method.
The basic idea is pre-logical. You first record the investment at what it costs you to buy it.
Initial cost. Got it.
Then, going forward, as the associate company makes profits or losses, you recognize your share of that profit or loss in your own income statement.
So your books reflect their performance proportionally.
Exactly. And if the associate pays out dividends.
What happens then?
Those dividends you receive actually reduce the carrying amount, the value of the investment on your books, because it's like getting some of your investment back in cash.
Right, it makes sense. Your investment value adjusts with their earnings and distributions.
Yeah.
So that's the core equity method. Where do the paths start to diverge a bit between IFRS and US GAAP? Where are the nuances?
Well, the differences really emerge in some of the, let's call them finer points, how you handle the initial costs, subsequent adjustments, and especially impairment, how you account for a drop in value.
Impairment, right. Always a tricky area. Let's start with IFRS. How does it handle initial cost and the adjustments?
Okay, so under IFRS, that initial cost includes the purchase price plus any transaction costs, lawyer fees, broker fees, things directly tied to making the acquisition.
Ah, so transaction costs are capitalized.
Yes. Then, after that initial point, the carrying amount, as we said, goes up or down with your share of the associate's profit or loss, but also, importantly, with your share of their other comprehensive income, OCI.
OCI. Right, things like certain unrealized gains or losses that bypass the main income statement.
Exactly those. So your investment reflects your share of their total comprehensive income, not just net income, and dividends reduce the value, as we mentioned.
Okay, and impairment under IFRS.
For impairment, IFRS looks at the entire carrying amount of the investment as a single asset. It gets tested for impairment whenever there are indicators it might be impaired. Crucially, any goodwill that might have implicitly been part of the purchase price isn't tracked or tested separately. It's all bundled together.
A single unit test.
Okay.
How does US GAAP handle impairment then? Is it similar?
US GAAP also starts with cost, and the subsequent accounting for earnings, losses, and dividends is broadly similar, but impairment is, well, different.
How so?
Under US GAAP, you recognize an impairment loss if the investment's fair value drops below its carrying amount, And this is the key part, that decline is judged to be other than temporary.
Other than temporary. That's something that involves quite a bit of judgment.
It absolutely does. You have to assess if the drop in value is likely permanent or just a temporary blip. It's a different trigger and assessment process compared to the IFRS approach.
Yeah, that other than temporary hurdle under US GAAP. It feels like it could mean impairments get recognized, maybe less often or later than under IFRS's approach.
It certainly could lead to different timing, yes. An analyst comparing two similar companies, one on IFRS, one on US GAAP, might see different impairment charges hitting the income statement because of this rule difference.
Definitely something for users of financial statements to be aware of. Now, you mentioned earlier, or rather the source did, a fair value option. Both standards have this. Why opt out of the equity method?
Yes, both offer a fair value option, though maybe for slightly different reasons or circumstances emphasized. Under IFRS, it's explicitly mentioned for entities like venture capital organizations, mutual funds, unit trusts, basically entities whose business is investing.
Right, where the market value is arguably the most relevant figure.
Exactly. For them, measuring at fair value with changes going through profit or loss, FETPL, might provide more relevant information to their investors. And importantly, under IFRS, you have to make that choice right at the beginning, at initial recognition. You can't just flip-flop later.
Okay, locked in from day one for those specific entity types, and US GAAP's fair value option.
US GAAP also has a fair value election available. If you choose it, changes in fair value hit net income. While the principle is similar, offering a market-based view, the specific eligibility or rationale might be framed slightly differently. The core idea, though, is providing an alternative when the equity method might not fully capture the economic substance for certain investors or investment types.
That makes a lot of sense, especially for, say, a VC fund where performance is market value movement. Okay, let's talk losses. What if the associate isn't doing well? How deep do the losses go for the investor?
Both frameworks are pretty aligned here. The investor recognizes their share of the associate's losses, reducing the investment value on their books.
Even if it wipes out the original investment value, down to zero.
Yes, even down to zero. However, both IFRS and US GAAP generally say you stop recognizing further losses after the investment hits zero.
Okay, so there's a floor.
Usually. The exception is if the investor has specific obligations like legal guarantees, or maybe they've implicitly committed to funding the associate further, a constructive obligation, or if they've actually made payments on the associate's behalf.
So unless you've taken on extra responsibility, you don't go into negative territory on your books for that associate's losses.
Correct. It prevents potentially unlimited losses from an entity you don't control.
Okay. And what happens if the relationship changes? If the investor, say, sells some shares and loses that significant influence?
Good point. When significant influence is lost, both IFRS and US GAAP say you stop using the equity method. It's no longer appropriate.
So what do you do instead?
At that point, the remaining investment is typically treated as a standard financial instrument, usually accounted for at fair value going forward, depending on the classification under the relevant financial instrument standard. The loss of influence triggers a switch in accounting models.
Right, from reflecting underlying performance to reflecting market value. The source also mentioned potential voting rights, like options or warrants. How do they fit into deciding if significant influence exists in the first place?
Yes, potential voting rights. Both standards agree these need to be considered, but only if they are currently exercisable or convertible.
Currently exercisable.
It's about the potential power you could wield now, not some hypothetical future power. And you also have to consider the investor's intention and, crucially, their financial ability to actually exercise those options or convert those securities. Just having options isn't enough if you can't realistically use them.
So it adds another layer to the assessment, not just current shares, but currently accessible potential shares, too. Now, I think the document specifically called out IAS 28.5 under IFRS. What's the focus there?
Right, IAS 28, paragraph 5. It really hammers home that significant influence is about the capacity or ability to influence, not necessarily whether you're actively flexing that muscle every day.
The potential matters more than the action.
Exactly. And it gives examples of indicators, things to look for, representation on the board, participating in policy decisions, major transactions between the investor and associate, swapping managers, providing essential technical know-how.
A kind of checklist of qualitative factors.
A non-exhaustive one, yes. It guides the assessment beyond just the percentage.
Does US GAAP provide that same level of detailed sort of indicative factors?
The underlying principle is definitely the same in US GAAP, look at the substance. However, our source does note that IFRS sometimes has less specific implementation guidance in certain niche areas compared to US GAAP, which can be quite detailed. But the goal is identical. Figure out if there's real influence.
It really sounds like, despite these differences in maybe the specifics of impairment tests or the exact wording around fair value options or the level of detailed guidance, both IFRS and US GAAP are fundamentally trying to get to the same place. They want the accounting to reflect that economic reality of having significant influence, that middle ground between passive investment and full control.
I think that's exactly right. The mechanics might differ slightly, leading to potential variations in reported numbers, but the underlying objective showing the impact of that relationship is shared.
Okay, great. So let's try and summarize the key points. We've established that for these investments in associates where you have significant influence, the equity method is the go-to under both IFRS and US GAAP.
Right. Initial cost adjusted for your share of their profits or losses, and OCI under IFRS, just profit loss typically under GAAP, and reduced by dividends.
But we hit some key differences, especially in impairment testing. IFRS looks at the whole investment as one unit.
While US GAAP uses that other than temporary decline in fair value trigger.
We also saw the fair value option exists under both, though perhaps emphasized for different types of entities, like VCs under IFRS.
Yep, an election made up front.
And handling losses recognized down to zero, but generally no further unless you have extra obligations.
Correct. And you stop the equity method if you lose significant influence.
Plus, considering those currently exercisable potential voting rights in the initial assessment.
Don't forget those.
So the big takeaway seems to be similar destination reflecting influence, but sometimes slightly different routes, especially regarding impairment and maybe fair value application.
Precisely. And understanding those different routes is vital if you're comparing companies across the IFRS GAAP divide or even just deeply analyzing one company.
Absolutely. So for you listening, hopefully you now have a much clearer picture of what's going on behind that investment in associates line item. It's not just a number. It reflects a specific type of economic relationship, accounted for under rules that, while similar in goal, has some important practical differences.
Which leads us to maybe a final thought for you to take away. Thinking about these differences, how might they actually change how you interpret a company's financial health or its strategy? When you see that investment line, what other questions pop into your head now? What should you be asking about the nature of that influence, the accounting choices made, and ultimately the real economic ties between those companies? Definitely something to chew on.